Hi, it's Mike Power, Silver Range, and here's a quick look at the junior exploration market, where we see it's at and where we see it's going. First, a quick word from our lawyers. This presentation should not be construed as investment advice. We'll start with a quick look at markets and particularly market cycles. We'll turn to financings, our coincident indicator of market health. We'll have a look at option activity and wrap it up with a look ahead. Turning to markets, the TSX Venture is widely used as a proxy for the health and condition of the junior mining exploration market. Here's the venture since the COVID downturn in March of 2020. I'm not sure it's the best overall indicator of junior mining exploration health because it's also got many listings from other industries, but nonetheless, it's used. Here we are, and we're well along in a market cycle going into year 5. I think the CXC Composite Index might be a better indicator of junior mining exploration market health, insofar as the CSE has a much higher proportion of junior mining companies listed. Here's their chart since the COVID downturn, and if anything, it looks worse than the TSX Venture chart. The VanEck GDXJ ETF is composed of smaller producers and more advanced gold exploration companies. It is a gold-focused fund, and it turned around last March and suggests that the top end of the market might be rebounding. But as we've seen from the overall CSE composite chart, the junior explorers are not doing quite so well. To put this all in context, I think we need to look at market cycles from a long-term perspective. Now, what we've done here is we've stitched together the TSXV since its inception and formation, together with the older Vancouver Stock Exchange, and finally extended it prior to 1991 with the TSX Junior Gold Index. And we get this time series here, which, as you can see, contains a number of cycles. And these are marked by a run-up after a capitulation trough, generally quickly to a peak and then a decline. The exception might be the 1999 through 2008 cycle. But in general, you get a rebound, a bit of a peak, and then it slides down to the next capitulation trough. If we look at statistics for this admittedly small sample database, only 8 samples, we nonetheless find there's a mean of 6.5 years. That's the average duration of a cycle, and a standard deviation of about 2 years. So 6.5 years plus or minus 2 years is a good benchmark, I think, for the average duration of one of these junior mining exploration cycles. And what that means is that if you want to bet on statistics, that the odds of a market turnaround by next November are only about 30%, but they rise to about 50% by November 2026. So if you're just betting the odds, they probably don't favor a turnaround right now. But if you're in this market, statistics may not matter, and especially in the latter stages of a cycle where there might be a few winners to be picked in an otherwise dark board. As I pointed out earlier, the market cycles tend to be characterized by a rebound from a market trough, but these rebounds can vary in duration and intensity, and it might be useful to just take a quick look at what they might look like so we could perhaps recognize one if it happens this year. Here's the earliest one we have in the Toronto Venture data. It's from 2003, and that was a 12-week turnaround from the trough to a clear turnaround and rebound in the index. In 2008 and 2009, it took 17 weeks for the market to rebound from the capitulation trough to clear upward trend. And in 2016, 11 weeks, and finally in 2020, it took 14 weeks. So on average, it takes about 14 weeks or 3 to 4 months before it's very clear that a market has turned around from its nadir. So that's a point to keep in mind perhaps when we're staring hopefully at market charts. Let's turn to financings. We believe financings are the key coincident metric of junior mining exploration market health. They're the one metric that doesn't lie, regardless of the gloom or enthusiasm of analysts. We believe that looking at financing data provides the clearest indication of where markets are right now and perhaps where they might be headed. We track all exempt distribution financings in Canada. This would be share issuances plus debentures and so forth. And we developed thresholds to assess whether a market is in good, bad, or indifferent territory by comparing it with historic TSX venture data. I've gone over this in the past. I won't go over it in this presentation. Okay, we believe there are three indicators that provide the best assessment of overall junior mining exploration market health. The first of which is the total number of financings raised. This is the least reliable indicator because it's highly influenced by a few very large financings in any period. These would be the purple financing bars you see here. They're far and away the largest contribution to the amount of money raised. But the important ones are actually the smaller ones. In terms of where we're at now, we are in basically on the borderline between depression and okay territory with respect to total financings raised. However, if we turn to financings less than 2 million, our second metric, we find that the market is actually in worse shape. These are financings done by the junior explorers trying to raise money to keep the lights on and run a few small programs and make those discoveries. And they're having a tough time raising this money. And it's gotten worse since Christmas of 2024. Our third metric is the proportion of financings less than $200,000. In this plot here, those are financings that are in red and orange. Analyzing data back to 2003 indicates that you need to see the proportion of these small financings less than about 20% for a market to be in okay or good territory. When markets turn down, the number of very small financings as a proportion of the total increases dramatically. Here's our data since 2023. It's been in depression territory since we started recording it. And if anything, things have turned down since the start of the new year, and this situation is worsening. So 2 out of our 3 financing metrics indicate a market depression, and the total financings raised are on the borderline between a depressed and okay market. Okay, well, financing show us where we're at. What's of interest to us is what do the promoters think might be of interest in the near future? Where might the market be heading in terms of where its focus might lie? And the best indicator of that is to look at the properties that promoters are optioning. Here's option activity back to 2022, summarized from Stockwatch. And here we've broken it down by the commodity of the property being optioned. So the gold and silver are in red, base metals blue, battery metals in green, and uranium in gray. And you can see that the number of options fluctuates. It's at a sort of a steady longer term level right now. Normally we would expect it to be a little higher earlier in the year and then wane towards the middle and latter part of the year. That's been the historic pattern. If we look at the proportion of different commodities being optioned broken down by property, we see that the interest in uranium is definitely on the wane, as well as battery metals. Even base metals are not quite as popular. However, there's quite a lot of interest and a growing interest in precious metal properties. So the promoters are betting on gold and silver for the near term at least. Well, to wrap up, I wish I had good news, but unfortunately the data suggests that the market has deteriorated since the beginning of the new year, and market conditions remain quite depressed, particularly for junior explorers at the bottom end of the market. Statistics suggest this downturn may continue into next year sometime. And if there's any hope, it's in precious metals. That's where option activity appears to be shifting. Well, thanks. I hope you found this interesting. And we'll do it again in the fall or sooner if that hope for market rebound appears in sight. Thanks.